Hello everyone, and welcome to Fundamental Auditing, Chapter 12. Chapter 12 is on the purchases, payables, and payment process. So in Chapter 11, you saw the revenues, receivables, and receipts purchase. So this is basically opposite. It's the purchases, payable, and payments process. So same kind of layout this chapter is designed as the previous chapter. The first thing that we need to do as auditors is understand the purchases, payables, and payments process. Because they are a major part of the cash outflow. So there has to be high levels of management planning and control to make sure that there's no fraud occurring in this cycle. So to assess the risks, the auditor has to figure out what the purchasing cash payment transactions are and the accounts payable. So understanding the business and how things are purchased and what are the approvals in place, authorizations, how our payments process and all that will help understand to figure out what are the risks involved or the gaps in the process. So existence, ownership, completeness, valuation, and disclosure must all be considered when figuring out is there a risk, that the payables aren't valued properly or they're not complete. So Exhibit 12-1 shows the activities around this process. So purchasing the goods and purchasing the goods and services and then paying the bills. So let me just show you the process here. So first thing would usually be to request a purchase. So if somebody needs to purchase some inventory or some other sort of asset, there would be a purchase requisition and hopefully an authorization in place, a process to authorize the request. Then there'll be a purchase order that maybe you would fill it out online, for example, and send to the supplier. Then you would receive the goods and services. So receiving a report, put the goods in the inventory accounts, put the fixed assets in the productive service, right, wherever the fixed assets need to go, like machinery in the factory floor, and then put the services to use. Then you would receive a supplier's invoice, and then enter the accounts payable from the invoice, and then pay the cash. Okay, so checks or EFTs or cash, and then you would have like the requisition, EFT reference code, purchase order, receiving report, and supplier's invoice, and then the cash payment would make it into the cash payment transaction file. So the accounts that are involved in this process or in this cycle are your raw materials, work in process, and finished goods inventories, the PP&E, insurance, supplies, various expenses that you're paying for, the cash payments, and then the accounts payable. So those are all the accounts that are involved in this purchases, payables, and payments process. Okay, oops. So back to our PowerPoint here. Okay, so when looking at authorization, so purchases that are made by the purchasing department, there should be, authorization in place, approvals in place before someone can purchase. There should be competitive bids put in place. So if you're going to purchase something, something big, depending on what the amounts are, you probably want to have like 3 different bids, for example. So go to 3 different companies to find out what price they're offering, and then choose usually the lowest price or whatever the good quality, look at the quality and price of the service or product you're getting. And this is to avoid like favoring one vendor over the other, for example. If the person in the purchasing department has a friend in another company, they'd want to purchase from them so the friend can make money as well. Maybe they'll receive kickbacks or something. So it's good to make a procedure in place where they have to shop around and get at least 3 bids, and then somebody will pick which one to do. So disbursements are authorized by an accounts payable department. So purchase orders, invoices, and receiving reports are matched prior to the actual payment, and then checks need to be signed by an authorized personnel. So this is when they pay the money for the goods. So the person that's authorizing the purchase shouldn't be the same person that's recording the purchase, shouldn't be the same person that is signing the check. The custody, so the receiving department will receive the goods purchase and then forward them to the proper departments. So there should be a receiving department that gets the inventory, for example, checks to make sure, does all the checks and balances to make sure the inventory amounts match up to what was ordered, and then send it off to like the warehouse. Same thing for like supplies or anything that kind of comes in. Custody of cash is a responsibility of the personnel assigned to authorize and sign checks. Okay. Blank documents, such as blank checks, is also considered like in custody. Somebody will have to have custody of the blank checks or like the blank purchase orders or purchase request forms, stuff like that. Okay. So you want to make sure the person that's receiving the goods isn't the same person that's authorizing and signing the checks. Purchases should be recorded once the purchase order, receiving report, and vendor invoice are matched. Okay, so there has to be three-way matching here. So the purchase order should be matched to the receiving report saying that the goods have been received and the vendor invoice that you're getting directly from the supplier. And then disbursements are recorded once the checks are prepared. So once the checks are prepared, that's when somebody would go in and record the get rid of the payable and credit the cash. There should be a periodic reconciliation of existing assets to what the recorded amounts should be. So maybe physical inventory is compared to the accounts. So there's an inventory count happening where maybe on a monthly basis, there's an inventory count to make sure what is on the warehouse floor is the same with whatever is on the inventory account. Bank reconciliations should be prepared, like in the last chapter. Fixed assets are compared to those in the account. So if you could do a physical count of the fixed asset compared to what's in the accounts. And then a trial balance of accounts payable is compared to a control account to make sure the balances line up there. Management will produce several reports, which may be helpful for the auditors to get their audit evidence. So usually like from the system of processing purchase and payment transactions, you'll get management will get reports, which could help auditors get evidence. So there could be an open purchase order report. This would satisfy completeness around accounts payable. So the evidence that the auditor can get is what are the purchase commitments, what's the valuation of inventory. There could be unmatched receiving reports, so something that does not match the purchase order. So maybe the purchase order is missing or something like that. So therefore there could be accrued liabilities for purchases. Unmatched vendor invoices. So if a vendor invoice does not match the receiving report or the purchase order, that we'll be looking at validity for this. So maybe there's unaccrued liabilities. Looking at the accounts payable trial balance will show the existence and completeness of payables. Looking at the purchasing journal, we'll look at what was expensed and whether it was reasonable. There'd be a bunch of inventory reports showing this is the amount of inventory that's on hand or in the warehouse at a certain time. So this will help do an inventory count. It could help figure out what the valuation of inventory should be. So we can use management's reports to help us get started to figure out what type of audit procedures, or to help us to check if whatever is in these reports is not materially misstated by looking at the additional evidence. Right. Just a couple more. Fixed asset reports could show the changes in the fixed asset balances. So it could show the fixed assets opening net book value, what the depreciation was, and the closing net book value. This will help do a recalculation of depreciation expense. it could help pick out a sample in order to a sample for additions to fixed assets to test. And then the cash disbursements report um, will help to see if there's proper cutoff for payments. When doing a control risk assessment, we need to look at, I guess the accounts that we would have to look at is inventory, PPE, depreciation and amortization expense, sorry, PPE and intangible assets, accumulated depreciation, amortization, accounts and notes payable, cash, and then any expense categories like an administrative, selling, and manufacturing. Okay, so these are all the accounts that are affected by this purchases payments process. So some internal controls that should be put in place is that there should be proper segregation of responsibilities for the authorization, custody, recording, and reconciliation. So the same person that's authorizing the purchase shouldn't be the same person that has custody over or receiving the inventory, shouldn't be the same person that's recording the inventory, and shouldn't be the same person that's doing that periodic reconciliation of the inventory. So like an inventory count, for example. Okay, so those 4 duties should be separated. So then there's no, and that one person can, do a purchase order and take the inventory and steal it. Right, so the persons that do have the custody of the assets and have custody over cash reimbursements, like the blank checks, shouldn't be the ones that are doing the accounting. Okay, so there should be a bunch of controls in place, like having signatures. Only certain people can provide their signatures on the checks. Making sure, like maybe sign off or initial when you've done the approval or authorization. Having physical security over the inventory. If the inventory is in a warehouse, like make sure it's locked, make sure that maybe there's security cameras, maybe there's a security guard, and just having policies and procedures around all these controls. When you're doing test of control procedures, it should address all of the control objectives. Cutoff is important to do the valuation of inventory. So making sure no inventory is included at year end that should be included for the next year. Okay. Auditors need to determine whether they can rely on the accuracy of the perpetual inventory records. Okay, so you want to do the testing of any additions or purchases, any reductions of account balances. We'd have to look at that too to make sure it matches like the sales, for example. Testing does need to take place from looking at the actual physical inventory in the warehouse to the account, and then the other way around too, from the account to the physical inventory. So basically, we would have to look at what is on the warehouse floor and does that match the records, the accounts, and then we'd look at the accounts and does that match whatever's on the warehouse floor. So we would take a sample of items from the inventory listing and make sure that the physical inventory is there in the warehouse, and then we would do the opposite, take a sample of physical inventory and determine if it's actually in the inventory listing. So going from the warehouse floor and picking a sample of physical inventory to the inventory listing will satisfy completeness, and then the other way around from the listing to the floor would satisfy validity. So exhibit 12-4 has some control tests. So let me just show you that. Okay, so there's a bunch of control tests that first thing you have to do is understand how the control activities are implemented. And then for purchases, for example, you can select a sample of receiving reports and then make sure it's vouched to the related purchase orders. Make sure that the purchase orders, there's no like missing numbers or in the receiving reports. Trace the inventory record posting of additions to the receiving report. So if the receiving report is saying that we got, that we received something, received inventory or something, make sure it's recorded, so posted in the additions. We can scan for missing documents, missing numbers in like the EFT numbers, the payment checks, right? You can search for missing check numbers. So where would have those gone? You can select a sample of recorded expenses from various accounts and then vouch them to canceled checks or EFT references and supporting documentation to determine if they were actually paid. Okay, so lots of different things that you can do depending on what type of controls there are. You would want to make sure that they are in place by testing them. When you're looking at substantive procedures, Exhibit 12-7, 12-8, 12-9 shows the audit program and assessment and audit procedures for accounts payable, inventory, and PPE and intangibles. A continuity schedule is a working paper that shows movements in the account balances and the other accounts that should tie in with them. We would look at the relationships in the continuity schedule to analyze like the impact of misstatements discovered in the audit. So let me just show you one of these. So Exhibit 12-7 goes through an audit program for accounts payable and accrued liabilities. Okay, so same type of thing I showed you for the revenue. Okay, so the types of substantive procedures that you would do is recalculate the total on the trial balance and then trace to the total in the general ledger. You would vouch a sample of supplier statements. What else? We would conduct a search for unrecorded liabilities. I'll explain that in a little bit. Okay, other part. So these are just some of the types of procedures that can be done on accounts receivable. Okay, so agree each balance to the general ledger, compare with prior year. So that's just some of the types of audit procedures that can be done. Scan the expense accounts, compare with the prior year, investigate any unusual differences of maybe there's a big expense and why. Okay, and then prepared by, date, reviewed by, and date there. Oops. All right. One thing that around the audit procedures around inventory should be a physical inventory count or a physical inventory observation. Okay, so usually we do attend the inventory count because having the wrong amount of inventory, if it's like inflated, for example, could have a big material misstatement effect on the financial statements. So auditing standards require that an auditor has to observe the inventory and make test counts. So they don't have to count the whole entire inventory all the time. What they can do is they can attend the inventory count that the client does. So at the end of the year, the client will probably do an inventory count so they can determine what their year-end inventory balance is. So an auditor can show up at that count and just observe and kind of oversee to make sure that it's being done right, or I guess to get comfort that it's done right. What else that auditors can do is they can do test counts. So like I was saying, they can go in to the inventory count and then say, okay, so I see you have product 1, 2, 3, 4 on your inventory listing. Show me where show me where those actual inventory items are. So then the client would take you to those, show you that yes, we actually have those. Or the other way around, you can pick out some inventory items and say, okay, show me where on the inventory listing these inventory items are. And so we would basically do a sample. So we would do a sample there. So we would have to do like a testing of the inventory count in order to gain assurance on the inventory number. First thing you have to do is review the inventories count instructions. Okay. If count procedures look good, then the auditor can rely on the account to produce good results, and then we would just test a sample of them. Doing the physical inventory count will help test for existence completeness and then valuation. So after you know how much inventory is there, then you can calculate the value of it. The physical inventory count should happen at year end because that's what the inventory balance is based on. But if it happens like a few weeks after year end, for example, so for example, if you're not hired by the audit client until year end is over, maybe 2 weeks after year end you're hired, or 1 week after year end, right away there should be an inventory count done, sorry. And then the auditor can do rollback procedures to determine what the amount was at year end. So for example, if it's January 15th is when the inventory count is done, you find out what the inventory balance is on January 15th, and then any sales or purchases of inventory from January 1st to January 15th will get backed out, and then you can find out what the inventory balance should have been December 31st and compare it with what's on the financial statements. If the company does not take a complete count on a single date, but rather they do it in cycles, we need to make sure that the records, their perpetual inventory records, are accurate. Okay? If the audit is not present at the client's inventory count, the auditor must review the client's plans for the count and then do some like test counts of the current inventory, just to see if the records are reliable. If there's some inventory located off the client's premises, an auditor might decide if they're material and the controls are not strong. The auditor might visit those locations and conduct on-site test accounts. If the amounts are not material and the control risk is low, then they might just get confirmation from whoever the custodian is of how much inventory is there. Okay? So if there's a bunch of different warehouses at different locations across the country, depending on the materiality of how much inventory is at those locations, the auditor might have to go and visit those locations. In addition to doing the physical count of inventory, the auditor also needs to consider if there are any consignment relationships. So are there any goods that are out there that customers have that they haven't, that might have to come back, right? That might still be in inventory. Or any goods that are in transit, which is the like whose responsibility, whose property is that, of the client or of the third party that bought that. Okay, and whether there's any goods on hand that have been sold but not yet delivered, because those shouldn't be included in the inventory count. So that all has to be taken in consideration when doing the inventory count to see should all the inventory that's on the warehouse floor be included, or is there things that have been sold already but just not delivered. Looking at the audit of property, plant, and equipment and intangible assets, the evaluation can be high risk and challenging to verify, especially if the company is using fair value accounting for the property, plant, and equipment. You'd have to make sure that an appraisal is done independently and kind of compare that to what they've done. Intangible assets would be hard to value, so the valuation of that would be high risk because it's hard to kind of value what the intangible asset is, because it's hard to to prove that the cost that they said is an intangible asset is actually there. Okay? The main presentation issues are ensuring that the accounting policies for PPE are appropriate and disclosed, and the values of the PPE elements are represented on the balance sheet. So the main concern over property, plant, equipment, and intangible assets is who's authorizing the acquisitions. Is there proper classification of assets and expenses? So for example, should something be a capital asset or should something be in repairs and maintenance? So maybe it's just like a wear and tear issue of like a car, for example, like an oil change of the car. Should that go into repairs and maintenance or should it go into capital asset? Well, it should go into repairs and maintenance, but maybe they've added it to their capital asset. So we just need to make sure that capital assets that are recorded correctly and should not be in expenses. We would have to figure out the accuracy of the depreciation calculations, making sure that depreciation is recorded every year and the calculation is correct. So we would do a recalculation there. Looking at the appropriate revaluation or impairment testing. So have they done testing for impairment? Maybe we would re-perform the impairment testing to determine should there be an impairment or not. Um, some of the substantive procedures, we would do physical inspection of the PP&E. We would inspect documents like purchase documents, ownership documents. We would do recalculations. We might have to use experts regarding the valuation, especially if it's an intangible asset that's complex and specialized. Or if they're using fair value accounting for their PP&E, we'd probably want to get an appraisal to determine what the fair value should be at year end. Inquiry is important to get evidence, but it's not enough. You still have to keep going and getting additional invoices to figure out the valuation. When looking at the completeness assertion for liabilities, when looking at obtaining evidence around accounts payable and other liabilities like long-term liabilities, for example, we need to put emphasis on like the completeness and obligation assertions. So usually companies are usually quick to record assets and revenues, but are less concerned about recording expenses and liabilities, right? So they might want to hide some liabilities and expenses to show more net income and maybe a better like debt to equity ratio if they have a debt covenant put in place so they don't show a breach of covenant or something like that, or they want to have their current ratio high or something. So we need to do a bunch of tests for the completeness assertion. So we have to look for, are there any unrecorded liabilities that exist that have not been recorded in the financial statements? Yeah, so we would have to search all the places where evidence of liabilities might exist and check if they have been recorded in the financial statements or not. Okay, let me show you a few procedures to test for unrecorded liabilities. Okay, so this is in the textbook, the very last page. So maybe there's a missing tax payable amount on your liabilities. So we would inspect the CRA notices of assessments, which may show that that there is a liability that they need to pay. Or we would look at contingent liabilities. So contingent liabilities are payments of like uncertain timing and extent. So maybe if it's probable that they're going to lose a lawsuit, they would have to record a contingent liability. So what we would want to do is we would want to send out a lawyer letter to their lawyers to request for information about any pending or threatened litigation to determine whether we need to record a contingent liabilities. For long-term debt, we would trace the liabilities to the like bank confirmation, for example. We would look at any debt due within 1 year and whether it's classified as a current or did they make it long-term. So you look at like the debt agreements to see if those have been recorded properly on the statements. Okay, so you're gonna look at any unrecorded liabilities that could be present. So you're testing for completeness more for your liabilities. All right, so that was the end of chapter 12. Thank you for listening and take care.